Hello, everyone. Welcome to our discussion about the credits in Chapter 9. We're going to start, this will be Part 1, and we'll finish up with a second one, Part 2. But our first credit we're going to talk about is a non-refundable credit. So just quickly an idea between the difference between refundable and non-refundable. A refundable credit can be received if as a refund if you even if you don't have any tax liability. A non-refundable credit can only does you good. It only helps you if you have a tax liability. So if you have zero tax liability, the credit that is non-refundable, you can't get that back. So it's important to know which ones you always are going to apply the non-refundable credits first. So if you have a tax liability of $1,000, you're first going to apply the non-refundable credits to reduce that, and then the refundable credits, and it's separated on the tax return, page 2 of the 1040, for that very reason, because you always want to apply the non-refundable credits first, reduce tax liability as far as you can go. If it brings it to zero, okay, and you can't use it all, then that's fine. You move to your refundable credits, which can be used even if there is no tax liability left. So this first one is a credit for child independent care. So it used to just be child care, now it's dependent because it can apply to someone who is disabled. But typically what we're talking about is the idea is you need to pay someone to watch the kids or take care of the kids while you work. Okay, so the first thing you have to have is you have to have a qualifying individual, right? And that's a person under 13. Okay, so it's not the same as some of the other things in the tax law. This is age 13. That's a dependent. Okay, that same concept that we talked way back at the beginning of what a dependent is. Okay, it has to qualify. All right, or a dependent or spouse of the taxpayer who is incapable of caring for himself. That's the disabled part. Okay, so child under 13 or dependent C under 13, or one that can't take care of themselves. Okay, so an elderly parent could be a qualifying individual. So first thing to remember is that you get a credit, and remember, a credit is used to offset your tax liability. So you have tax liability, you apply the credit. It does not affect your taxable income. It is not subtracted from your income to get your taxable income. It is applied to your liability. It's offset against your liability. Okay, the amount you get as a credit for this dependent care credit is never 100%. It's always a percentage of what you actually pay for the care for the qualifying person or qualifying individual. Okay, and it's the percentage between 20 and 35%. And the lower your AGI is, the higher your percentage is, but it never goes to zero. Okay, and then there is this other wonderful restriction that can seem somewhat onerous on this credit, and that is with the qualifying, how much you paid. Doesn't matter if you paid $10,000, because the only amount of the expenses you can consider is $3,000 if you have one child or qualifying individual, and $6,000 if there is two or more. It doesn't go to $9,000 for three. It's two or more is just $6,000. So the most you can use to calculate is $6,000, no matter how many qualifying individuals you have or providing or paying for care for. And to make sure that this is about getting, having work, okay, you have to limit it by the income of whichever the lowest paid spouse, okay, whichever is the lowest, okay. Now, they wanted to provide a kind of out for those where one spouse, okay, you're married filing jointly, one spouse is working, the other spouse is going to school, full-time student, or is incapable of caring for themselves. So they are actually a qualifying individual for this. Okay, we're going to treat that second spouse is going to school, not earning income, okay, as if they had earned $250 per month that they're in school, not the months they're not in school. All right, or $500 if you're talking about 2 kids or more. So if you think about that $250 a month is $3,000, and the $500 per month is $6,000. So this basically means that if you're going to school, you just have your only limit is not the income, it's the $3,000 to $6,000, except for you have to pay attention to how many months it actually is. All right, here is the percentage you use. Remember, it's never 100% of what you spend. Okay, it is based on this. Notice there's no limit. If it goes over 43,000 AGI, it's still 20% up to whatever, unlimited. So remember, it's the idea you have 3 things you have to consider: the amount that you paid, the $3,000, $6,000 limit, and the income for the lowest paid spouse, unless that is a non-working spouse, and then you can count it the same as the $3,000, $6,000. All right, if you're single parent, and obviously you are the lowest paid spouse, right? So, or parent in this case. So that's looking at the second parent. The idea is if one of this credit isn't for situations where one of the spouses stays home with the kids. All right. Where this can become fairly difficult is what if one spouse is working full time, but in a business that's just getting started. Maybe they started their own business. They're working all the time, but the business isn't making much money. That can still be a problem, because that would be a limit to how much you could consider for this credit. It's based on that income, which could be low when you're starting. So some examples. Single mom, so we don't have a second spouse. We don't have to worry about that. Okay, we have one child, one qualifying individual. Her AGI is 126, so she's well over the 43,000. Okay, but it still qualifies. She paid $4,500 for her daycare. All right, but she can only consider, right, 3,000 maximum. So obviously her income is high enough. We take that 3,000 for one child, one qualifying individual. On the table, her percentage is 20% because her AGI is over the 43,000, and so her credit is 600. Even though she paid 4,500, the credit is only 600. So she gets her tax liability lowered by $600 out of the 4,500 she actually paid. Okay, we got a married couple. They form jointly 2 dependent children. Jack and Jordan, they're both under the 13. Okay, Tom has 41,000, but Katie is a full-time student, but only for 9 months. Okay, no income. They paid $6,000. Oh, paid exactly the amount that the maximum you can consider with 2. All right, but we have Katie with no income. Okay, so her as the lowest paid spouse, all right, is going to be treated for the 9 months she's in school as having $500 of income. Now, it's not actual income. We know that. It's not put on the tax return as income. It's just for this little test here, 4,500. So that's what she could consider out of the 6,000. Now, that's not the credit. Then we take that amount and multiply it by the credit percentage based on the AGI. But you could only consider 4,500 because that's her pretend income, if you will, as a full-time student for 9 months. Okay, Antonio's a widower. That means he's single, okay, and cares for his son, age 4. Okay, his AGI is only 24,000. Pay expenses of 2,900. Okay, but received care assistance from an employer. Okay, which is excluded. That's going to reduce how much they can consider. All right, so 2,900 minus 1,000 really only paid 1,900. We use the lowest of the three. It's not his income. Okay, that's not the lowest of the three. 3,000 for one qualifying individual. That's not the lowest, but 1,900 is. Okay, and so we take that and we multiply it by 30%, and we get, that's the rate using the AGI of 24,000. We get $570 credit. Okay, whenever we use, for instance, if the $3,000 limit would have been used because his expenses were higher and we use a lower, we would still have to reduce that by $1,000 that with dependent care assistance. Whichever limit you use of the three is reduced by the amount of the dependent care assistance, because that is money you spent already tax-free. You already got a tax benefit for that. All right, education credit. So now kids grow up and they start going to school. Okay, so now we're talking about credits for paying for education. All right, notice it is for education expenses paid for the taxpayer, spouse, or dependents. It has to qualify as a dependent. You cannot just pay the tuition for somebody that's not related to you and still claim education credit. Okay, it all goes on Form 8863. There's 2 credits: the American Opportunity Credit and the Lifetime Learning Credit, and we're going to learn them both, but one is far more advantageous than the other. It's a lot higher, larger percentage. And again, we're going to look at it as a percentage of what we pay on education. We're not going to get 100%. So first of all, what is a qualifying expenses? Tuition fees and books, as long as the books are required. Okay, some other required expenses, sometimes if the computer's required, that can be, but not room or board. Okay, and the school needs to be certified by the U.S. Department of Education. Most schools are, but it can't be just somebody offering classes down the street, sort of thing. Okay, has to be able to work with student aid. So most of the ones that you know about would qualify. So first credit, that American Opportunity Tax Credit, is calculated 100% of the first 2,000 qualifying expenses and 25% of the next 2,000. So only 4,000, and you know that tuition can be much, much more than that for depending on the colleges, depending on. So the maximum, you hit that maximum very quickly. So 2,500, and that is per student. So if I have 2 kids that are in school, 2 dependents that are both in school at the same time, I can do American Opportunity Credit for each one. So if I paid 4,000 for one and 4,000 for the other, then I have a credit 2,500 and a 20 credit for the other one 2,500. So I could have multiple credits for multiple students. The amount you pay is always reduced by any money that they get as a scholarship too, by the way. Okay, the Lifetime Learning Credit, okay, is 20% of qualifying expenses. So notice the difference. It's AOTC is 100 and then 25%. 100% is a lot better than 20%. Okay, and it is maximum per taxpayer. So all of my kids together, okay, together is what it is the maximum. Okay, so it's really $10,000 of qualifying expenses for maximum $2,000 for all of me. I could pay for myself. I could pay for my spouse. I could pay for my kids. Okay, all of those. So the AOTC is really for your for those who are going to college for the first time. So it only is going to apply to situations where they're going to school to get a bachelor's degree. And you can't use any of the expenses twice, right? Okay. Okay, they both have the same phase out rules. They begin at 80,000 for single, 160, and phase out completely at 90 and 180. So it's not too low of a phase out, but it phases out pretty quickly because between 160, if your income is below 160,000, you get the full credit, and at 180, you get zero credit. Okay, so how does the phase out work? You got the formula here, okay, that figures out the amount that you're going to reduce it by. Okay, so you're taking the 180,000. That's the top limit, and you're subtracting what if you get negative, then obviously you're over 180,000, and so you don't get any credit. Okay, zero. But if it is under 180 and if it's under 160, you don't even worry about it. You just take the difference, divide by 20. That's the phase out range, and that's the percentage that is reduced, that you reduce the credit for. You get the rest. Okay. So, education credit concept checked. First one, okay. Jules is a single taxpayer and pay $2,900 in qualifying expenses for a dependent daughter who attended the University of Arizona full-time as a freshman. First 4 years, okay, getting a bachelor's degree. Full-time. Has to be full-time to get an AOTC, okay. How much is a lifetime learning credit without regard to limitations, okay? So if we couldn't qualify for the AOTC, which this would have, but if it didn't, then the credit would be $2,900 times 20%, right? $580. Okay. This time we're going to claim the AOTC, which would be far better, right? Because we always want to look at the AOTC first, and only if we don't qualify for that do we go to the lifetime learning. Okay. So 100% of the $2,000 and 25% of the second $900, so that was the total we spent, $2,900. And maybe they got scholarships or stuff. Obviously, the tuition was probably actually much more than that, but the rest was covered by scholarships or other things. Okay, so the total credit is $2,225. Okay, far better than with the other the lifetime learning credit, but we have to consider the phase out. Okay, because we bumped up the AGI in this case. The first AGI situation, no phase out at all, but we do have a phase out. Okay, because we're over this is the upper limit. We're gonna reduce it by 1,113. Okay. And then if her income is over 98,000, okay, she gets no credit, right? Because she's single, and so she's on that different phase out range. And that would apply if it was lifetime learning credit or not. So lifetime learning credit and the AOTC have the same phase outs, right? So the key thing to remember is that AOTC is better. Okay, it qualifies, it has a higher amount qualify, higher percentage, but it is limited to those first 4 years in school. It's limited to students who are full-time or more than half-time. It's technically the definition. It's limited to degree seeking, things like that. Once you've done it for 4 years and got a bachelor's degree, you can't use it again. All those kind of things with that particular student. The lifetime learning credit is far more flexible. Just about anything else will work. Any type of schooling, graduate work, things past the bachelor's degree, things that are part-time, just taking a class here or there. Okay, all of those can still work for the lifetime learning credit, that where the AOTC would not. But always look for the one, and then if you can't, you may go to the other. But remember that both are phased out because of income. All right, the last credit for this first part, okay? If we had income outside of the United States and paid taxes on it, okay? If we're citizens of the United States, we have to file a tax return. We have to report all of our income regardless of where it is made. So we report our worldwide income, and then we get a credit for the taxes that we already paid in another country for income that was earned in another country. Okay? So the credit we get is whichever's lowest, the amount we paid to the other country or the amount we would have paid in the United States if we had made it here in the United States. Okay? So what we do is we figure out how much we made somewhere else. We lived in part of the year in Finland, let's say, and we earned some income there. We take that income, divide it by our total worldwide income, get a percentage, and then we multiply that by our total tax liability based on our total income. And that's the income tax that we would have paid on that income in the United States. Okay? Then we compare that to what we actually paid, and whatever's lowest is what our credit is. So if Joy has $63,000, $8,000 from New Zealand. She paid $2,500. Tax liability is $17,640. So we go $8,000 divided by $63,000. That's the percentage of our income that we earned in New Zealand. We multiply it by our total tax liability as if it all got made in the United States. Okay, we get $22,440. That's less than what we actually paid, and so that credit is $22,240.